welcome to this Q2 Market Perspectives video. My name is Andrew Krei. I'm the Co-Chief Investment Officer here at Crescent Grove Advisors. And on behalf of my colleagues and myself, thanks for taking a little bit of time to watch this video. We're going to go through a little bit of what we saw in Q2, in addition to look at some of the key themes that we're watching going forward, how that's going to impact your portfolio. And we'll sort of tick through 4 different things on this video. So for starters, we're going to look back and do the postmortem on Q2, which is really a continuation of the volatility that commenced in Q1. Take a look at the recovery that we saw in equities, which was pretty extraordinary by any measure. We're going to look at the economic outlook. We'll kind of come at it through the lens of the Fed, and in particular, their focus on the labor market and inflation. Sort of touch on those 2 factors and how those play together in terms of their outlook for monetary policy. We'll talk about fiscal policy, which was subsequent to the end of Q2 in the news with the One Big Beautiful Bill being passed and signed into law. Touch on that in a moment. And then we'll close by talking about the US dollar and kind of the implications that the dollar has on diversification and some of the things that we're watching for markets outside of the US in particular. So without further ado, we'll jump in. So as we think about what we saw in Q2 and we think about the severity of the decline in the S&P 500 in particular, and then this extreme snapback, what we're showing here on this chart, looking at a historical context for what we saw in terms of, again, the depth of the drawdown, which was about 20%, let's call it, and then how quick, the rapidity at which we achieved a new all-time high under 90 days, which when you compare it to 98, the COVID period, 2018, et cetera, these different dates that we've plotted here on this chart, was the fastest recovery that we've seen for markets experiencing a drawdown of that magnitude. But I think when you kind of decompose the returns and look beneath the surface of what was going on, what we're doing here on the right side of the chart is to say, okay, where have these indexes or these different subcomponents finished on a year-to-date basis? And if you looked S&P 500 value stocks, growth stocks, all up about 6% at this point. But then look at what the sort of magnitude of the drawdown was for each of these underlying components, right? We saw value stocks only down about 14% from their peak during the height of the volatility, whereas growth stocks, and in particular, if we want to highlight the Magnificent Seven, that cohort of mega cap tech stocks that have done so well and been driving so much of the market performance, we're down about 26%. And then you take a look at also developed international stocks, emerging market stocks, only down about 14, 15%. You think about kind of the dichotomy there that we saw between the segment of the market or segments of the market that have much less demanding valuations relative to segments of the market that trade at pretty extreme multiples in a historical context. Yes, they ended up at largely the same place in the US, again, with that 6% rate of return year to date. But if you think about it from a volatility or downside adjusted perspective, this is why we've been talking about value stocks and, again, non-US stocks in particular, offering a nice margin of safety if we were to see a period of volatility. And certainly as we go forward, we would anticipate similar dynamics. If we shift to the economic outlook and think about from the Fed's perspective right now, how are they looking at the labor market? How are they looking at inflation? And then how does that feed into their broader forecast for GDP growth? What we did was to plot on the left side of this chart successive meetings where they've done economic forecasting, looking out for 2025 and essentially saying, where do they sit from the Fed's best guess perspective, sort of consensus forecast on GDP, the unemployment rate, and inflation. And what you could see is a pretty consistent trend where GDP growth has been revised lower. A lot of that has to do with policy uncertainty, the impact of tariffs, et cetera. And then inflation has been revised higher, also to do certainly with tariffs and the potential for prices to, sort of this pull through as consumers pay more for goods that are now being tariffed, certainly from rest of world, right? And then you think about the unemployment rate, also a key portion of what the Fed is looking at as part of their dual mandate, also sort of revising that modestly higher. So the real trick here for the Fed, and we talked about this a little bit last quarter, is that if they continue to see inflation potentially rising, and it's not just the Fed that's seeing this, you're also seeing this play out through other market-based measures of where investors expect inflation to finish this year and certainly even going forward into 2026. If inflation is moving higher, growth expectations are moving lower. And you see a labor market, as we point out on the right side of this page, that is sort of creeping in the direction of being a bit more perilous, particularly as it relates to jobless claims that are ticking up or new job creation that's moving slightly lower on a moving average basis. the Fed's just going to have to kind of sit and wait, notwithstanding some sort of break within the labor market on their policy settings, because they're going to have a really hard time lowering interest rates if inflation's moving higher. And again, if the labor market's holding up reasonably well, it's unlikely that they're going to move off of their current policy settings. They'll be much more data dependent going forward. Now we'll talk a little bit about fiscal policy and what we saw subsequent to the end of Q2 with the passage of the One Big Beautiful Bill. I think certainly that had something to do with the recovery in Q2, where we saw this handoff and narrative from worries about tariffs, worries about monetary policy, to perhaps a bit more optimism around what fiscal policy would bring, and in particular, an extension of the tax cuts, some other elements that would provide a fiscal impulse within the economy and the corporate sector. I think that had something to do certainly with the quickness of the recovery that we saw in the S&P 500 as that transition was made. The question going forward, and what we're presenting here on this page, is looking at what that ultimately means for deficits going forward, and in particular, the overall debt levels within the United States. So if we look at the bottom right-hand portion of this, where we sit today, about 120% debt to GDP within the US. If you kind of play out the forecast based on where we're seeing deficit levels today and the legislation, again, that was just passed recently, you would see about 160% debt to GDP over subsequent decades. And of course, that's not something you observe any month or quarter necessarily, but it's more of an insidious thing that happens over time, where debt continues to creep higher, interest costs continue to creep higher as a overall percentage of the budget. And I think what that means then for markets and implications in portfolios is, if I'm an owner of a 10, 20, 30-year treasury bond, long maturity bond, where I've got more uncertainty around what the debt levels are going to look like in another decade or two, I'm going to demand more compensation for that as an investor. So all told, we would anticipate that yields probably have a bias towards the upside as a result of what we've seen with fiscal policy. Certainly, again, helpful for equity markets in the near term, but something we would watch to sort of sit in the background as it relates to long duration fixed income, and then ultimately the implications around what a higher 10-year, what a higher 30-year treasury bond yield would mean. Last, we're going to talk a little bit about the US dollar and think about, I think, an underappreciated component of returns for investments outside of the US, for US dollar-based investors at least. So what we've seen here on the top left portion of this chart is that the dollar has had a 9% decline on a year-to-date basis when you take a trade-weighted basket, essentially, the US dollar index, as it were. So pretty significant decline on a year-to-date basis. And then think about, again, what that means for your non-US investments in your portfolio. So take the right side of this page and let's just isolate Europe, for instance. You see market impact, meaning just sort of prices move higher to the tune of about 15% in Europe, excluding the currency component. So certainly a good 6-month period, no doubt, for European assets. But then when you add on the fact that the currency impact as well, a function of, again, the euro strengthening relative to the dollar, is added about another 14% to your return. So you're overall talking about a 29% return on a year-to-date basis, which, again, I think for a dollar-based investor, for so long, it's been difficult being outside of the US. The diversification hasn't really held up its end of the bargain. It's really just paid to concentrate in those tech names that have done so well within the S&P 500. But if we see an environment where, at least at the margin, investors are funneling assets towards Europe, towards Japan, towards emerging markets, the dollar's weakening, there's more policy uncertainty within the US, it's a bit more protectionist, isolationist. All told, it pays to be diversified, not only, again, from a geographical exposure, an underlying company basis, but also from a currency perspective as well. I think you add onto that the fact that these markets trade at much less demanding valuations relative to the US, and we continue to see a pretty good setup for non-US assets relative to US assets on a relative value basis going forward. All right, so that concludes our Q2 Market Perspectives video. I'm Andrew Krei. Thanks for watching.